Hello, everybody. Welcome to Ask the Planman. I'm your host, Bruce Weinstein, and with me today is John Browning, the founder of Guardian Rock Wealth and the author of How to Build a Life, Not Just a Portfolio. Welcome to Ask the Planman, John.
Well, thanks for having me, Bruce. I appreciate it. Looking forward to chatting a little bit today.
So why don't you tell the audience a little bit about the book, the emphasis behind the book, the message in the book, and what your value or belief system is, let's say.
Absolutely. It was a fun journey to write the book, and it's because it's born out of my own personal experience. You and I have talked a little bit about spending about 30 years on Wall Street and going back and forth to Chicago to New York to all over the country, and having 6 children, and realizing at some point I was just on this treadmill. I was chasing the dream, and hey, it was lucrative. That was cool, but I wasn't really building the life that I wanted. Not right then, and not building a life for the future. And that's the premise for the book. But then it goes into several different chapters, 8 chapters in all, that kind of goes into that.
Let me stop you before we get into the chapters itself. So by the definition of build a life, what did build a life mean to you, and how would that resonate to the people listening? What does their life mean to them, and where might the disappointments or the challenges be that you're hoping to address in the book?
Yeah, I think that many times, and often this happens when we're younger, is we have this belief system that we have to get the college degree, get the job, and get the money, and get the car, get the house, and get, and we forget the things that we really enjoy. So how I believe it works best is to start with, what are those things? Really spend some time thinking about what are those things that we truly enjoy, and it's different for everyone. And is it a house in the hills, or is it a house on the beach, or is it traveling around the world, or is it just curling up with a book by the fireplace? And it's different for everyone. What do you enjoy, and why you enjoy it? And then where do you want to go? Very few people have really thought that. They think, oh, I want to have $10 million. I want to have 5. Well, why?
Well, they don't even know what it means or what it's going to do for them. It's just an abstract number. So something I used for many years in my goings with clients is Woody Woofy. What's your Woody Woofy? And Woody Woofy stands for, what do you want for yourself? And so as you're describing it, is everybody has their own Woody Woofy. What you want with 6 kids is different than what I want with 3 kids, right? And so what you want, when you want it, and how do you go about doing it, is going to help define, hey, what's Ask the Planman? The Planman's all about planning. You're here because you're a quintessential planner for your clients, as are we. And we collaborate together for the audience to know that John does majority of asset management and planning, but he doesn't necessarily do the insurance, and we do the insurance without doing the asset management. And so we collaborate with people like John in helping give people that full comprehensive coverage, across the board, from investments and insurance and estate planning and tax planning and the like. So sorry for that tangent. So back to the Woody Woofy side of it is, to me, as you're describing it, is helping people identify, prioritize their objectives, and then tee it up for them to execute a plan. Is that?
That is it exactly. I'm continually amazed by, when I sit down, especially when you sit down with a couple, and you start to speak with them, and you ask them that why question, and you don't just ask it once, but you ask it 2 and 3 and 4 times, and invariably the one side of the couple will start to get a little quiet.
Right.
And what we do is we sort of interrupt that, and we say, hey, Jane or Joe, whichever one's being quiet, I notice you're getting a little bit quiet, and I'm curious as to why that is, and do you think something different? Well, I'd really like to hear from you. And suddenly it becomes a marriage counseling thing, right? And and it's funny, what I do, what my expertise is in asset management and creating what you want, but finding out what you want first is a big part of what I end up doing, especially on the front end.
Yeah. I've always said over the years is I wear my therapist hat, I wear my financial advisor hat, I wear my insurance agent hat. Like you got to wear a lot of hats. And I think the biggest thing that you and I have been successful is helping people manage their expectations. I think that's paramount in what we do, why we've been successful for as long as we have. As I jokingly say in my trailers, I've earned these gray hairs, been around the block a
Yeah,
while.
mine's turning white.
And
Almost like,
yeah, I'm getting there. I'm looking like Paulie Walnuts from The Sopranos more and more. And the emphasis has always been for me is to make sure people have realistic expectations, whether you're managing their money or their insurance, is they need to know that none of this, in essence, is prescripted and guaranteed. I can't control the performance of the market. I can put you in a position to succeed, but whatever happens is going to happen. And either you like to eat better or you like to sleep better. How do you want your money managed, right? And so if you like to eat better, means you want to make a lot more money. You're going to take bigger risks. You're going to have higher highs and unfortunately lower lows. The person that wants to sleep better, well, they don't want to see volatility, right? They just want, they want to know, they open up their account, that money's not going in a downward projection, right?
right.
So eat better or sleep better is part of your Woody Woofy.
Yeah,
Right?
and that's a great analogy, and it's very true. And by the way, nothing wrong with either side of that. It's just who you are as an individual. I mean, you can't really operate very well without sleep either. So,
Right. You got it right. It's as Mike Tyson says, everyone has a plan till they get hit in the face.
yes,
Right.
exactly.
So you could have the greatest plan in the world until the market takes a dive, like it did right at the beginning of COVID.
Yeah,
Right.
well, even the past 6 months.
30%.
Yeah, past 6 months have been kind of that way. Yeah.
Well, it's getting choppy again, but it hasn't been a 30% decline in a week.
Yeah, no, yeah, exactly.
Everybody's changing their diapers. Like it's a big problem. It's panic time, right? You get to a point of panic, and so in that vein, it's not that I don't want to talk more about the book, but the some of the points I wanted to cover today. We'll talk about market volatility and the eat better, sleep better. But before we go down that path, just let's cover a few of the topics in the book. And how you help people break this down, that whether they want to pursue somebody like you professionally or to me the show is to help people help themselves, whether they get professional advice or they do it themselves. We want to give them enough nuggets. And my what's the word I want? My moniker of the show is "So What," right? Let's answer the question, so what? When people are listening to the show, so what? Like, why am I listening to these two knuckleheads, right? They got 65 years of experience, but so what? What are they going to do for me? And so I want to give the audience the abilities, again, not going to solve anybody's problems in a half an hour session, but to give them enough to either have them pursue themselves or dig in and do some research, find somebody in their local markets or reach out to to us and help find them somebody that can develop this for them. So go ahead. So let's break down a little bit of the book.
Well, in a nutshell, it starts with the question. It's the title of the first chapter is, what does money mean to you? And people struggle when I ask them that question. They're like, what do you mean? What does it mean, to me? And it's always so but it's a conversation starter, and it's the whole first chapter. And at the end of the day, our philosophy here at Guardian Rock is that money is a tool. And a tool in the hands of a master craftsman can create something wonderful. And the other point that I like to bring up is that money magnifies. So if you're a miserable person, then more money is going to make you more miserable. Everybody thinks money's going to make them happy, but it's not always the case. If you're a happy person and you do wonderful things, more money's gonna you're gonna end up doing more wonderful things with that money. It happens every single time. So we talk about that first, and then we talk about understanding your values is chapter 2, and it's really about getting down to what really matters to you, because again, we're all different, right? And that's part of the beginning of the plan. And the plan doesn't come until chapter 4. Chapter 3 is the Snowflake Theory, and that's we're all different. And it's okay. You don't have to have the Porsche. You don't have to keep up with the Joneses, and I think that's a big part of the battle, right? In the book from way back, and I'm showing my age again here, Millionaire Next Door, I think it was called. It talks about that. There's so many millionaires out there that are driving a Toyota Camry or whatever it is they drive. They're not driving the flashy Porsche or Ferrari or whatever it might be.
But they got $2 million in the bank.
But they got $2 million in the bank. Exactly.
Right.
So from there, what is your plan of action? That's not till chapter 4. And having that plan, as you know, being the plan man, paramount.
You can't hit a target you can't see, right? I got a lot of cliches here. You can't hit something you can't see. You can't get to your destination if you don't have a map and a way to get there, whether it's electronic these days on your phone and whatever it is. But if I'm a 30, 40, 50-year-old couple and I have ambition to retire at X, how do I know how to get there? What do I really need? And a lot of what I've used over the years is the simple story. If you won the lottery, right? We all have that fantasy for a $2 scratch off. I'm going to win the lottery and I'm going to stop working, right? And so the lottery ticket represents that financial freedom to do what I want, how I want. And so what I've shared with clients over the years is you already have your lottery ticket. You just don't know the turn-in date, right? You don't know when you can actually redeem it. And that's what the planning process does, is it gives you the semblance. You have all of this, you're on this path, these are the rates of return that you're anticipating making, and this could be your execution date, age 62. Or if you want this, it might be age 65. And if you really want to be aggressive and get out at 58 or 55, you need to do this. And now you're giving them options, right? You're setting expectations. You're showing them. Now, you and I come from a different ilk. Like, whether you have enough money or not, are we really going to stop working at 60 or 65 or 70? We're in the helping people business. And the beauty of what we do is we can work from anywhere and we can help anybody anywhere. So I'm not forced to retire. I'm not, working manual labor that my back's breaking and my discs are herniated and I gotta stop at some point. So as long as the mind is cognitively working, we're a social creature. And I find, here's another one I say, what are you retiring to, John?
I call it life after formal work, because I like what I do. I really enjoy it, and I've done it for 30 years. I don't ever plan on sort of retiring, but there will come a day when the mind is maybe not as sharp or whatever, or I just want to do a few other things and have some other experiences. So I want to cut back, but probably never stop.
If you take a school teacher that works for 40 years, is getting a pension, and they get to the point where they want to grab that brass ring, I get this, I get this, I get this. Is it enough? Can I really stop working at 60, 62? Do I have to go to 65? This is what people like you and I do, is help them map that out and give them the confidence that it's a one-time decision, that they can afford to do it, whether they're ready emotionally, psychologically. 3 years into it, they want to go get a job because they're going crazy. Well, that's different. That's different. That's emotional. That's what am I doing with myself all day? And, years ago, I'll tell you a quick story. I had a couple that we helped, and we built the budget. Right, budget's very key. We're not going to get deep into budget today, but the budget's the epicenter. What are you going to do with your time and your money, and what do you want to do? And for most of us, it's to travel. And so we built this budget that he was projecting he would need or want, and forecasted out. Rates of return modest. Da da da. Okay, fine. And he retired. Like 6 months later, he calls me up. He's like, I think we need to do the numbers. I said, why? He goes, I'm not going anywhere. I'm not spending any money. I get a bagel and coffee every day. I'm spending like $100 and we have an $8,000 a month budget. He goes, and I'm not spending it. So what should we do differently? Right? So so what in that story? We got a so what. The so what is, it is trial and error until you're living it. Right? We have a work life and a work lifestyle and a vacation lifestyle around work. And now all of a sudden the work's gone and life is different. And you may or may not be comfortable in that new paradigm. And you may seek to be a Walmart greeter or, the golf club starter and something. Because guess what? It's social. You're getting out. It's not the money. It's the socialization.
Yeah.
So again, I'll shut up and you can chime in.
Yeah, no, that's so true. I see it every day. Is the plans for retirement is much different than actually retiring, and a lot of time, like you said, it may take 6 months, and that's what people tend not to realize either. Is that in the first 6 to 12 months of retirement, you do tend to spend more, right? Because you're like, woo, party. And then you realize
I'm going to Hawaii. I'm going to Alaska. Yeah. We're going to to Europe and Asia. Yeah,
yeah, and then you're like, well, this is not really what I want to do all the time. It's like it's kind of tiring to travel all the time, or whatever it is that you're doing.
So you mentioned earlier 6 kids. We raised 3 boys, and so here's a question I'll pose to put this into a basket here. What's the longest vacation you have taken with your family? Days-wise.
10
days, right? I mean, would you say most of your clients, while they're working, like maybe 2 weeks is going to be the stretch, right? Like, we've been blessed to travel over the years, and I think the longest we were away was like 16 days. By day 9 or 10, I'm missing my bed. I'm missing my pillows. Like, you miss the routine. So as much as it's great to travel, the creature comforts of what you're used to kind of come in, and all of a sudden it's like, I don't know if I want to be away for 3 months. Like, it's really, really it changes. And so to the point of the so what here is your fantasy of I'm going to go travel for the summer. You've only been conditioned for your 40 years of work life to go away for a week, 10 days, maybe 14. You have extended holiday break at Christmas and New Year's time. But yeah, the human element of it, the dynamic is, I don't know. I just wonder if you experience it. I'm sure listeners out there have experienced it, because I know I have. It's like, I'm ready to go home. Like, I need my bed back. So anything else in the book chapter wise? So you get to the plan. So obviously it's the pre-qualifying and defining some things, and then getting into the nuts and bolts, and then what's in the back end of the book? What happens after the plan?
So the back end is you get hit in the face. No, I'm just so Mike Tyson says. But it's really how to avoid, and this is really, you get hit in the face, right? How to avoid common mistakes that tend to happen. Should you trust a financial advisor? Should you go it on your own? Of course, I'm biased, right? But I have seen a lot of train wrecks. We watch CNBC. We're just flooded with information, right? We watch CNBC. We read the Wall Street Journal. We go on YouTube and Facebook and all those social media channels, and we get all this information, and you feel like this is easy.
I don't know what to do. Oh,
so
okay.
Yeah, exactly. Or I don't know what to do, and that's when you call.
You got paralysis by analysis,
right?
I'm sorry. You got paralysis by analysis, and then you have The other
Oh,
side
oh,
is
I can do this. This is easy. Just listen to
right.
CNBC, and then you buy, like, I think every stock in the S&P 500 five different times.
Right.
Mm, But it's, I used to be on the shows, the CNBC shows with those guys. They're not bad people, but they
No,
get paid differently than I do. They get paid to
that's right.
sell advertising. Right?
They're not getting the screaming phone calls at 3 a.m.
Yeah, exactly.
from
Exactly.
from the unhappy client, right?
Right.
The dot com craze of the 90s,
Yeah.
right? We're going back in a ways,
Yeah.
but I would meet people. We were doing retirement planning seminars, and people would come up to us and say, "I just turned $100,000 into $1 million. What do I need you for?"
Right. Right.
And this is when Lucent and AOL and Yahoo, all these the nifty 50 go-go stocks of the dot com, which eventually all imploded, right? And about a year later, he hired us because he got the crap kicked out of him. Because, as they say, getting in is easy, getting out is hard,
Right.
right? And so he thought he was a genius. He thought, and this is really early CNBC days even, but the point is, to what you were saying, is you get so much out there. Oh, Bitcoin. I'm just going to throw money in Bitcoin. Look how much money I'm making in Bitcoin. And it sounds so good. And then, FOMO, right? Fear of missing out. And everybody wants to get in. Well, when it goes from 60 to 40, somebody's losing that. Somebody sold at 60 and somebody bought at 60. So the question is, why did that person sell at 60? And more importantly is, why did you buy it at 60 when you could have bought it at $1 or 5 or 10 or 20, right? So, being late to the party. So getting in is easy, getting out is hard. And that's your punch in the face, right? Is everything's good to go until, and I started in 1986, not 1886, everybody, 1986. And no sooner as a young stockbroker at Merrill Lynch, 8 months later, 10 months later, was October crash, right? Now, fortunately, I didn't have too many people in harm's way because I was still new. But so I came up in my career through that and the 90s with a certain amount of corrections and crashes, and then the dot-com, which put us in another window. And so these last 10 years, to come full circle, has been an amazing run where you could start to look at the parallels of the dot-com, and it's become too easy. And you and I know all things end badly. Otherwise, they wouldn't end. So it's. I'm throwing in a lot of my little sayings today. All things end badly, folks. Otherwise, they wouldn't end. And so the stock market in general, I think, John, you'll agree, it doesn't have a date on the calendar that says today's the day we're going to crash.
No, it doesn't have that.
It's not premeditated, at least by us or the general masses, maybe by some power, but it's going to end badly because something's going to be a catalyst, as we had in the dot-com crash and the financial crash and the Gulf War and 87 and 1929. Like, something creates a level of panic, right? And so, to the point of being prepared for that punch in the face is, and I wanted to segue and talk a little bit about asset allocation, right? Is how you build your portfolio, how you diversify your risk exposure is how you get through the punches in the face. Because eventually, as we've seen in 35 years, markets still go up. They just don't go straight up year after year, day after day. There's volatility. And how you manage that volatility is what ultimately the planning process, as John executes, is going to help you, the client, avoid as much of the hiccups and, let's call it pain, right? It's the pain of, oh, gee, I just lost 30%. Like, this is my first week. Or I just retired and I thought I was retiring with this, and all of a sudden it's this, right? Go ahead again. I'll shut up.
Yeah, and that's exactly, you segued really well into chapter 7 and 8, which is, and this may scare some people, but it's the seventh chapter is called Complex Adaptive Systems, and that one gets a little bit more meaty. The difference between a complex adaptive system and just a complicated system is that the adaptive and complex system cannot be figured out like a math problem. A lot of people think quantitative analysis in the stock market and for portfolios is the end all be all, but the problem with that is you have 7 billion emotional beings on planet Earth that are all making emotional decisions, because we all do. And I give some examples of that that are somewhat humorous in the book, including at my expense, how I've made some emotional decisions in the past. And when you have all that going on, there is no way to truly predict that market movement, right? There's a lot of analysis that you can do, but understanding the emotional impact of all those decisions is a big part of successful money management and creating that best life outcome in the future. And all that's about that asset allocation and how you put things together. And then chapter 8 is the right experience matters. And so, you may have experience as an electrician, and I've tried to do my own electric, and it sort of works, and I've been shocked a few times. I had a shocking experience. I've tried to do my own plumbing, and it's subpar at best. Do you really want your life, your retirement, to be done by, something that that's not what you focus on. You're not the expert on that.
You said before 7 billion emotions or emotional beings. And again, enlightening back to the various market declines over the years, something I would say to clients is, you don't pay me necessarily to get you in, but you're going to pay me to keep you in. Because when your emotions take over, logic goes out the window. And you and I both know when everybody's running for the door, that's the time to be buying. And when everybody's euphoric, it's probably time to start trimming back, right? Is the contrarian approach, and the real smart money folks zigs when everybody else zags. And so that's been my experience over the years. And what I've told clients is, the sale is on, things are 30 and 40% off. If you're at Macy's and they're having a sale, are you waiting for the sale to be over to go buy full price ties and sweaters? Or are you going to pick up a few items when they're on sale? Right? Oh, my $100 tie is $60. Well, let me get 3. No. I'm going to wait for it to be not only on sale, or off the sale, sorry, and back to 100, but I'm going to wait till it's 120, and then I'm going to go buy a tie, because now the trend is with me, right? And so from an investing standpoint, our job, the biggest challenge to our job is protecting our clients from themselves, because the emotion and the panic button and the pain is what will drive them to your chapters of massive mistakes and blowing themselves up. And then, of course, once they have that capitulation and experience, they don't tend to come back. And they miss out for the rest of their lives, because now they're just a bank CD investor, right? And that's the 1929 Depression generation, and the parents, my parents that came out of that and being children of those, they come with different baggage. The generations now have totally different paradigms, have lived through different eras, don't see that, a 30-year-old, my 30-year-old doesn't understand what transpired the last 50 years in the markets. And it's going to take way different risk until what? Until somebody punches them in the face. And they're going to go, holy crap. But I remember 2007, 8, and 9, how bad, 9, 10, 11 were. And we eventually, got through that. But that looked like we were going to be a 10-year black hole like 1929 again. And fortunately, it stemmed itself off. So, we can keep going. So I mentioned asset allocation a little bit. So let's spend a few minutes on that. And
what I want to hit some so whats is, again, you mentioned a little earlier at the beginning of the show that the last 6 months, the markets have been choppy, right? It's been some downward trending, and, we're seeing rotations, meaning, for those who don't understand, certain sectors of the market have been moving up, other sectors of the market are moving down. The indexes may not reflect that, but if you owned the wrong sector, you're getting your teeth kicked in. And if you were, playing the energy stocks when nobody wanted them a year and a half and 2 years ago, well, now you're printing money, right? Because oil is $100 a barrel, and not that long ago, you could have been paid to take oil from people because oil had gone negative, right? And I kept saying, I need a place to hold 1 billion barrels of oil, and I'd be set the rest of my life. Like, how can I get this done? I'm gonna drain every pool in Boca and just fill it with oil. Well, you know what? A year later, look, I would have been, we would have been buying somebody's private island.
That's right.
So let's talk a little bit about, best we can, without getting too deep in the weeds, of what asset allocation is about, why it's important. Because to me, I was always an asset allocation disciplinarian. And with that comes, I'll set the stage, is periodically over time, you sell your winners and add to your losers. And I'm using that in quotes, people, is your outperformers will not always outperform, and your laggard performers will not always lag. And as we've just seen the last 6 months, right, with oil, that was lagging in 2020, 2021 with COVID, and now oil is the big leader. So if you didn't put some money in oil a year or two ago and sell some of your Tesla, Amazon, Microsoft, Apple, right, which is doing fabulous, made people boatloads, but do you sell 2%, 5%, whatever it is, and prune the tree, right? Asset allocation to me is pruning the tree and replanting those prunings for the next seedlings to take off. And that's where you get outperformance and overperformance versus lacking and underperformance. Because if you have it all in here and it collapses, well, you just lost, you gave all your money back. There's no hedge. So again, I'll come back to you. I was trying to set the stage there. So
no, it's a great analogy again. That whole pruning. So way back when I was in high school, I did a landscaping to kind of get ready for college and save up some money and all that. And when you prune back a bush or a tree, it kind of doesn't look good, right? It looks like, oh, what?
That's right. Yeah. Raw. It's got some rawness to it.
But if you wait, it comes back more full and bigger and more beautiful than it was before. And that's what that's all about. I saw a really interesting chart just, I think, it's like a month ago. And it showed a very well-known investor. I believe you might know his name might be Warren, I think. And it
doesn't sound familiar.
Some guy named that.
Beatty? Warren Beatty? No.
And it showed his performance, which was good. Good. And then it showed...
It's Warren Buffett, everybody. It's Warren Buffett.
You're right, yeah. In case you haven't figured it out yet. It's Warren Buffett. And then it showed growth stocks. Okay, so his performance was good, but growth stocks, right, which are stocks that maybe pre-earning or they're just, they're super innovative, right on the cutting edge. And those stocks were going like this. Well, then in the past 6 months, this is what happened. And it went straight down and kind of almost matched. And there's danger of it maybe even going below what Warren's performance was been. And
steady Eddie.
And the argument in the underneath that graph was, see, those growth guys are kind of dumb. They're they don't know what they're doing. But here's the deal: if you were shaving, not necessarily eliminating, but shaving off little bits and putting them in the Warren Buffett portfolio all along, you're going to be right in the middle. So you're going to be better than Warren Buffett, arguably, but maybe not quite as great as, I invested everything in whatever high-tech stock you might want to think about.
Right.
So that's...
It goes back to pruning the tree, right? And we said earlier, getting in is easy, getting out is hard. So it's not that you're going to say, I want to sell all my Apple when it gets to 100. It's, I have 100 shares of Apple, and maybe I'll sell 5 or 10, and then let it split, and they go up. And again, it's just having a system, or really the word I use is a discipline. Every 6 months, once a year, whatever it is, prune the winners. If you go out and look at any asset allocated classification, large cap, mid cap, small cap, international, value versus growth, they all have different patterns. Take a 10 or 20 year window, the leader never stays the leader, the loser never stays the loser. And I used to have this periodic chart the mutual fund companies used to put together. It was a 20-year history, and I'd give it out to every seminar guest. And I would say, I don't care what the color is, I don't care what's the name of the color, look at the pattern of the color. Red goes up, red goes down. Green goes up, green goes down. Yellow goes up, yellow goes down. And they all intertwine, and they all may be up at the same year, and they all may be down at the same year, but some are going to be down 40%, and some may only be down 2%, right? And conversely, some could be up 40%, some could be up 5%. So the key in this is to be diversified, right? Not get emotional, have either an advisor give you that guidance. Look, being diversified isn't owning 5 tech stocks.
Right.
Right?
Yeah.
That's not being diversified. Let's be clear. So you might have mutual funds, which are made up of different stocks and not own just 5 different stocks, but you don't want all of them to be buying the same sectors or industries and areas of the market, because you got a car riding on 3 tires that something's going to give and the next tire is going to blow and you're just going to crash, right? And so you're trying to avoid that by being properly disciplined, properly diversified, and, as we talk, have a plan, right? You're not just buying it for the sake of buying it, but what's my target and what happens if I lose X, and when do I bail versus buy more, right? I mean, that's where you turn to John for, hey, what do you think? And it's not that John or anybody else out there is going to know definitively, but they're going to speak from experience to give you guidance and say, this is what I've seen in the past, and this is why I'm giving you the guidance I'm giving you. Based on what you told me, has something changed? Right? Has your plan changed? Has your Woody Woofy changed? I'm 5 years older and I want to retire next year and maybe I don't need all that exposure anymore. Beautiful. We'll go back to the drawing board and we'll recalibrate and we'll reposition your risk so that it doesn't punch you in the face.
Exactly. Yeah. And I think one other really important point about that asset allocation is that what worked 10 years ago, 15 years or 30 years ago does not necessarily work today in today's market environment. And what you see, especially among people, frankly, my age, is that they're still kind of in this era that believes that, and I'll explain what this is, the 60-40 portfolio always works and always will work forever. And the 60-40 portfolio is 60% in stocks and 40% in bonds or fixed income. And what has happened over the past 10, 15 years is that model no longer works. And there's math that goes into that, which we don't have to get into and scare everybody. But there's mathematical reasons why that portfolio is generally not appropriate for very many people today. And so what do? Well, there are new, just like in tech, just like in any industry, there are innovative things that the marketplace comes up with that can take the place of that 60-40 portfolio and work for you. And it does, unfortunately, yes, that does get a little bit complicated and complex. But that's something that you can talk to me about, you can talk to Bruce about, and understand it better.
So to John's point, when we came from the 80s and 90s, the 70s, 80s and 90s, we had very high interest rates. And so you could put money into a fixed income instrument called a bond, right? So when John's saying 60-40, 60 stock, 40 bond, well, you got a decent return in a stable investment. I said to you this at lunch, bonds are defensive. They're not necessarily safe, but they're defensive. And so under that vein, if stocks go down, the flight to safety usually pushes bonds up. The problem we've had is interest rates have been so low, historically all-time lows, that there's nowhere for bonds to go. And so that 60-40 model, you ran into trouble because the 40 wasn't generating anything. And if the 60 fell, the 40's got nowhere to go anyway because it's almost at zero, right? Okay. So that's what John's talking about is the crux of it changed. And so the force with low interest rates, the force became what you and I would call value stocks, is you would buy dividend paying stocks that might pay you 3, 4, 5, 6%, like an AT&T or a Verizon or maybe the pharmaceutical companies. And those historically are value stocks to your Warren Buffett pattern. Mm-hmm. And again, in that vein is if you look at value stocks over a long period of time and you look at growth stocks over a long period of time, they eventually level out to almost getting historically the same performance. Because stocks in general will perform within a certain band. And that goes back to what we touched on earlier, is setting people's expectations of, do they really understand the risk? Do they understand the history of the markets and the stocks? And what stocks are the most appropriate for them? Which then goes back to what? Eating better, sleeping better. Right? Yep. So the tie-in with this that I wanted to get, because as of today's broadcast, we've been seeing interest rates starting to creep up. Mortgage rates have come up. We've got a red-hot real estate market in this country, certainly hotter in other areas. We're in South Florida, but the New York market, people leaving New York, coming to Florida, California, people going to Texas and Arizona. But real estate prices have gotten crazy. And part of that was you borrow money at 3%. Right? 30 years at 3%. Well, all of a sudden, that's now shifting. And so the dilemma has been, in an asset allocated world, how do you manage an interest rate rising market in an asset allocated model? Because as rates go up, again, you and I know the answer, John, but for the audience, what happens to a bond that you got 3% when you purchased it, and now rates go to 5%? What happens to that bond?
Goes down.
Goes down. And it doesn't go down by pennies.
It goes down
it's
hard.
going to go down dramatically. Now, if you own an individual bond, you hold it to maturity, you're guaranteed your money back, right? But if you need that money while the market interest rates are against you, well, that loss is very real, right?
That's right.
And again, over my 30-year tenure in the space, a lot of people bought bond funds. And the bond funds have no definition of maturity. And so you get lambasted, right? From the frying pan to the fryer, right, as they say. So again, jump in on that.
Yeah, and this is from one of the many funds that I managed when I was on Wall Street. A couple of them actually were fixed income. They were bond funds. And I can tell you that what a bond fund does, mutual fund, is it makes a bond into an equity of sorts. And so it really changes the nature of what a bond is supposed to be. And that's one of the reasons that at Guardian Rock, even on the equity side, we own very few, if any, mutual funds, because I sort of made that sausage, so I kind of know some of the pitfalls. So we use other instruments that are more appropriate to the individual on that. But that's you're absolutely right on that, and people are shocked when they find out how much those go down.
That's right. It's always an adverse surprise. I was going to make the joke. I said, those who make sausage never eat sausage.
Exactly right.
When you see how it's done, it blows your mind. But yeah, if people have enough resources, again, diversification, there's investment risk, there's interest rate risk. I mean, we could spend hours going through all of that, and we'll have you back another time. But owning a bond fund will get you diversification, but then you lose the stability factor that an individual bond might possess, because you don't really know what the bond fund is made up of per se, and when a declining value could be recovered. And it's up to the portfolio manager to help hopefully mitigate that and bring it back. But, when I first started in my career in the 80s, we did a ton of municipal bonds. And for those that don't know, municipal bonds are tax-free. And we would have AAA rated New Jersey Turnpike 7% municipal bonds. And so you think about that, folks, that in a tax bracket of 40%, you get 7% for somebody. That's like making over 11% on their money, right? And again, historical rate of return on stocks has been what, John? Like 100 years. What the S&P 500 historical rate of return has been?
Right around 8%. I mean, just depends on exactly what years you use, but right around that 8% and change.
Right. And again, I used to say, large cap, 10 to 12, S&P 500. But yeah, so you're going lower than maybe I may have said over the years, but go back to 1987 and 1990, and you could make 11% on a pre-tax basis, 7% after tax with zero risk. That's sleeping better, right? Again, the audience is not going to know this name as much as you and I, but Ross Perot, remember Ross Perot? He passed away a couple years ago, but Ross Perot only invested in municipal bonds.
It made sense.
Because he was worth billions. He didn't need the risk to lose that a stock exposure might bring, aside from maybe his own company, right? And that company's stock and value. But all he needed to do was preserve his capital and make something consistent and tax-free. And it was probably one of the lowest tax-paying people in the country in his day, because everything he had was tax-free generated. Well, fast forward to today, 30, 40 years later, what are tax-free bonds paying, John?
Oh, it's. I haven't looked because they just haven't been worth looking at.
It's not. That's right.
Yeah, I mean,
you're talking 1, 2,
1%, and this is out. This is out 15, 20,
30 years.
30 years.
Okay.
Yeah.
Right. So again, it ties back to the so what when John's talking about that 60-40 paradigm that people have used. Well, that's old school, folks. If you can make 7% guaranteed tax-free, that makes a lot of sense. When you're getting 1% tax-free, maybe not so much, because
inflation is where right now, right?
Right.
Getting close to double digits, if not there and above.
Yeah, 100%. So, all right. So we've blown through our half hour. So hopefully people have stuck around and got some good knowledge and information from everybody. So let me thank my guest, John Browning. Again, his book is
Build a Life, Not a Portfolio.
I threw it to you, so I didn't look it up. And he's with
Guardian Rock Wealth.
Guardian Rock Wealth. So if anybody needs to reach John, certainly get in touch with us at the show. Let me give my little disposition here for everybody on the podcast. So this has been Ask the Planman. I'm your host, Bruce Weinstein. Please like, subscribe, share. Go to our website, asktheplanman.com. Hit us up at info@asktheplanman.com. Call our toll-free number, 844-PLANMAN. Get us your questions. We'd love to help address people. Have John come back, real life scenarios, talk about, John and I could share anecdotes of client experiences to the cows come home, and that's fine. And I hope people, get some value out of that. But there'll be nothing better than you and I to have somebody come on and dissect their situation and in real time give them some input feedback. Again, not solve everybody's problems. We're not giving them, very specific go buy Apple stock type of commentary, but help them dissect it and bring value to the audience of how a process like that might work. So we'll definitely try and put something on the calendar to do that. So again, Bruce Weinstein here, Ask the Planman. Thank you so much, John Browning, for being my guest today.
When you need some advice. Never sacrifice, always get it right. Ask the plan man. Finance, insurance, and more.